The foreign trade situation has really changed. Let me tell you something real. My friend had an American client for 10 years, but recently he got an email saying they are not going to work together anymore. The client found a cheaper factory in Vietnam, and there's no tariff there, unlike the 25% tariff in China. It's pretty disheartening, you know. So who's feeling the biggest hit from the export slump? It's the freight forwarders. My friend in freight forwarding told me that during the golden week of October in previous years, they were swamped with orders and couldn't even handle them all. But this year, it's been bleak, with lots of withdrawals and cancellations. Hardly any business at all. These companies that use sea and air freight are export-oriented, right? And their shipping costs fluctuate with demand. Like, why were the shipping costs so high in the past couple of years? Because there were so many orders. Now the slump really shows how bad the overall situation is.
Let's take a look at the changes in container shipping costs, which are pretty much a barometer for the economy and trade. Right now, the cost of shipping a container from Shanghai to Europe has plummeted by 40%, hitting a 4-year low. And to the US, it's down by about 20%. It's a clear sign that the economy is in a pretty weak state. Exports, traditionally a key engine of China's economic growth, have entered a 6-month recession. October saw a 6.4% year-on-year decline to $274.8 billion, exceeding the 6.2% drop in September and surpassing expert predictions. This suggests a third wave of economic downturn following the US-China trade war and the zero-COVID policy. China's National Bureau of Statistics released trade data on November 7th, indicating a continuous 6-month decline in exports. This reflects that even after abandoning the zero-COVID policy, China's economy has not stabilized but continued an irreversible downward trend. According to the General Administration of Customs, October's exports and imports combined decreased by 2.5% year-on-year. Exports fell 6.4%, underperforming market expectations and increasing from the previous months by 0.2%. Imports, however, increased by 3% to $218.3 billion, marking the first monthly growth since September 2022, leading to a reduced trade surplus. Experts cited by Reuters note a continuing decline in external demand, with Chinese exports expected to keep falling in the coming months, possibly bottoming out by mid-next year. China's economy has significantly declined in recent years, with the COVID-19 outbreak and the US-China trade war causing an economic downturn. The Chinese government blames this on US economic sanctions. Many Chinese companies evading US tariffs and backed by the Chinese government have engaged in rampant regulatory violations. Now, Chinese enterprises either close down or relocate to Southeast Asia amid supply chain shifts, resulting in a massive outflow of industries. Despite China's various regulatory violations to counteract US and global economic pressures, the country's exports and imports to major regions have consistently declined. Data shows that in the first 10 months, total goods trade value was $4.89 trillion, a 6% year-on-year decrease, with exports down by 5.6% and imports by 6.5%. ASEAN remains China's largest trade partner, with a bilateral trade value of $747 billion, down by 5%. The European Union follows, with a bilateral trade value of $655 billion, down 7.5%. And the US is third, with a bilateral trade value of $551 billion, plummeting by 13%, including a 15% decline in exports. China's trade values with major partners are nearly universally down, with the largest drops in Taiwan 18.4%, South Korea 15.7%, the Philippines 15.6%, New Zealand 15.1%, Japan 12.2%, the Netherlands 10%, and Germany 8.9%. In terms of exported goods, in the first 10 months, electromechanical products reached 11.4 trillion yuan, around 1.57 trillion US dollars, a 2.8% increase, accounting for 58.5% of total exports. Labor-intensive products saw a 2.4% decrease to 3.4 trillion yuan, around 467 billion US dollars, constituting 17.4% of exports. Among these, apparel and accessories dropped by 3% and textiles by 3.9%, while plastic products increased by 1%. The Wall Street Journal notes the continuous 6-month decline in Chinese exports, increasing pressure on the Chinese government to boost domestic spending. The drop in exports indicates global demand for Chinese goods is suppressed due to consumers and businesses grappling with slowing growth and rising borrowing costs. Economists suggest more measures are needed to prevent another economic slowdown in China, especially as real estate continues to suppress investment and consumer spending. With weak exports, China will have to rely on domestic growth sources for economic development this year, and possibly into 2024, a continual challenge. Recent business surveys show declining orders in Chinese factories and slowdowns in construction and service industries, indicating China's economy is still struggling. Capital economics analysts predict slow growth in imports but a continuing downtrend in exports until mid-next year. Examining export data earlier in the year, on June 7th, China's customs reported a 7.5% year-on-year decline in exports for May to $284 billion, and a 4.5% decrease in imports to $218 billion. The total trade volume for May was $501 billion, down 6.2% year-on-year. Media reports indicate a continuous decline in Chinese exports since October last year. After COVID-19 relaxation and the Chinese New Year, exports surged, with a 14.8% increase in March and 8.5% in April, but suddenly dropped to minus 7.5% in May. The surge in China's exports in March was attributed by Golden Credit Rating International to a backlog of orders delivered after the Chinese New Year, with April showing an unusually high year-on-year increase due to the previous year's low export volumes caused by Shanghai's lockdown. However, this upward trend reversed in May, as the effects of these short-term factors subsided. The decline in May's exports, worsened by a high base effect from the previous year's delayed orders due to the COVID-19 lockdown in Shanghai, was further confirmed by a continuous contraction in the new export orders index of the Manufacturing Purchasing Managers Index for both April and May. This contraction highlighted the issue of decreasing overseas demand affecting China's export sector. It's worth noting that the decline rates calculated in yuan and US dollars are different. The decrease calculated in US dollars is 7.5%, while in yuan it's 0.8%, mainly due to the recent significant depreciation of the yuan against the US dollar. Regarding the substantial decline in China's exports, US-based economist David Huang analyzed 3 major factors. First, the emergence of the Asian Alternative Supply Chain, consisting of 14 Asian countries and regions, including South Korea, Japan, India, Singapore, Malaysia, Vietnam, and Indonesia. According to World Bank data, from September 2021 to August 2022, the Asian Alternative Supply Chain totaled $634 billion in exports to the United States, surpassing China's export value of $614 billion. David Huang noted that this regional supply chain, more diversified in its products and covering a broader industrial spectrum, contrasts with China's relatively narrow industrial focus. He pointed out that industries like garments, textiles, and footwear, which are labor-intensive, are most affected. China's competitive edge is minimal in these areas, with new orders being significantly usurped by these 14 countries. China's competitive products are mainly in-home appliances, white goods, small electronics, and machinery manufacturing, along with some low-value-added products. Secondly, during China's stringent COVID-19 measures, these 14 Asian countries seized the opportunity to ramp up production and expand exports. Over 3 years, their exports to Europe and America have even surpassed China's, and this trend is becoming increasingly evident. Thirdly, the profitability of China's exports has declined. Before the pandemic, the EU and the US were China's top trading partners, with ASEAN a close second, Now, while ASEAN has become China's largest trading partner with a 9.6% annual growth, the trade surplus and profits from these regions are minimal compared to Europe and America. Huang highlighted that despite high export volumes to ASEAN, these are either unprofitable or yield low profits, and the more lucrative European and American markets are contracting. China is currently facing two major crises: internal deflation and a decline in foreign investment. China's published data showed its first deflation in over 2 years in July, and with the significant drop in October exports, concerns about China's post-pandemic economic recovery has resurfaced. Experts believe that deflation, apparent after the end of the pandemic and the restart of the economy, exposes structural problems in China's economy post 3 years of epidemic prevention. This includes worsening household debt conditions, suppressing consumer spending, evident from June's CPI figures. The situation in China, marked by weak demand, contrasts starkly with the United States and most Western countries, where efforts to control prices have not stopped the continuous inflation. Experts have called for more measures from Chinese authorities to boost demand. Iris Peng, chief China economist at ING, said, "The global economy is deteriorating and will weaken China's manufacturing sector. It is looking more likely that, in response, the government will step in to support the manufacturing sector's labor market through fiscal stimulus." In addition to currency tightening, China is also experiencing a significant reduction in foreign investment. A video from 2018, revealed in November 2023, shows Mattel, a company that once aimed to make the People's Republic of China its second domestic market, now accelerating its departure from China. Mattel, one of the earliest investing companies in China with nearly 40 years of history in its toy factories, is struggling to continue in the country. Against a backdrop of strained relations with the Chinese government, some Western political leaders advocate for decoupling from China, meaning cutting off all economic ties or at least reducing dependency on China. According to Goldman Sachs, foreign investment in China fell to its lowest level since 1998 in the second quarter. Analysts from Sino Insider, a consultancy specializing in China, states, "In this situation, the Chinese government has almost no options to salvage the economy." They also point out that the new anti-espionage law, effective from July, has raised concerns in the business community, further weakening investor confidence. Facing widespread negative public opinion, the Chinese Communist Party has resorted to authoritarian measures. According to reports from the Financial Times and Bloomberg, China has ordered its economists not to report excessively alarming news, especially regarding currency tightening. Chinese officials are working hard to dispel notions of deflation. In April, a spokesperson from the National Bureau of Statistics, Fu Linghui, emphasized that the current Chinese economy is not experiencing deflation and will not in the future. Dong Lijuan, a chief statistician at the Bureau, also announced that China's year-on-year decrease in CPI is temporary. She claims that with the economy recovering, market demand steadily expanding, and supply-demand relations continuously improving, coupled with the high base effect of the same period last year gradually fading, CPI is expected to gradually rebound. Furthermore, China's export trade is expected to continue declining. The Wall Street Journal reports that China's weak exports mean that the country will have to rely on domestic growth sources for economic development this year and possibly into 2024, which has always been a challenge. Julian Evans Pritchard, head of China economics at Capital Economics in London, quoted by the Associated Press, said, "The downtrend in Chinese exports may not have ended yet." He added, "Looking ahead, we expect exports to decline over the coming months before bottoming out toward the end of the year. Measures of foreign orders hint at a more significant drop in foreign demand than what has so far been observed in the customs data." In summary, the decline in China's exports will bring significant impacts to the foreign trade industry. and made in China is losing its grip on the international market. Coupled with China's currency tightening, this will further exacerbate the internal economic weakness, with many factories facing closure. The gradual withdrawal of foreign investors is undoubtedly a real reflection of China's economic downturn and authoritarian politics, with more and more people losing trust in the Chinese Communist Party's authoritarian economy.